Mr. Rathi, if you can share.
Yeah.
Yes,
So my
please.
question is that NBFCs are regulated by RBI, but AIFs have been given a absolute free hand. So as an expert, what do you think, when do you think RBI is going to go on AIFs which are into lending business?
I believe AIFs are being managed by SEBI. Again,
Yes.
a very,
They
very
are
robust.
regulated by SEBI. Yeah.
They're regulated by SEBI. Again, a very, very robust institution. And they also have the same objective of protecting investors. AIF collects money from mostly HNIs, and then they invest in either kind of whatever is the mandate to AIF. So they accordingly invest that. So AIF is fully controlled by SEBI. So I don't think there is any requirement of a dual control, one by RBI and one by SEBI. So even mutual funds are also controlled by SEBI. So the SEBI, in fact, also tries to protect investors. So RBI is not having any thought of controlling AIF functioning.
So it's basically a lending versus investment. I think we need to differentiate between lending and investment. When we talk about deposit taking NBFCs, we are looking at deposits, we're looking at NBFCs, we look at larger public money. When it comes to AIFs, the understanding is that AIFs are high risk investments. That is what AIFs declare to their investors also. AIFs also declare their investment philosophy with the investors, and if they are agreeing to invest, then they invest at their risk. So I think that's how I will differentiate that. Mutual funds versus AIFs, I don't see too much of a difference with respect to regulatory framework. NBFCs versus AIFs or NBFCs versus mutual funds, I think it's all dependent on what kind of they are all depending on systematic risks and also the size and also the investment versus lending thought process.
But I think one that Mr. Rathi is trying to take up a point that there are mushrooming in AIF segment. Everyone is trying to make one, two, or three AIFs, and they are also like pitching to the public at large for investment in their AIF. And the SEBI is presently not really very active on their, because SEBI has actually already said that it is a basically high risk investment, and I think there is a minimum size of investment, and that is, I believe, 1 crore. If Mr. Rathi has some information about AIFs more than us, then he can say that yes, minimum investment in any AIF is 1 crore. So that means
Yeah, it is correct. It is correct.
it is basically for high net worth individuals. So the market is kept open for them that if they want to take risk, and it is assumed by SEBI and RBI and government that they should be given a kind of free hand to take risk, and they should ask information from AIF, and then only they will invest. So they are feeling, RBI and SEBI is feeling that if a person is having 1 crore, that means that he's not a kind of masses. So he has that kind of access to professionals. So he can actually spend some money on the professionals to understand AIF and to understand the risk. That's what is probably the meaning. Any person who actually has 1 crore to invest in one AIF, that actually mean that he have the access to professionals also. Thank you, Mr. Rathi, for asking this question.
So good morning, everyone, and welcome back to our weekly webinar series. Today we are having our episode 174, and we are looking at further issues with respect to NBFC. We are looking at investment and credit companies today. And I would also use this opportunity to wish everyone a very, very happy Raksha Bandhan. Over to Anil.
Thank you, Ankit. I can see that you are in festival mood. Wishing all the audience happy Raksha Bandhan. So we are continuing with our weekly webinar series. Today is episode 174, weekly webinar. and we are continuing with our education series on NBFCs. So what we have learned in the past uh, episodes is the structure of NBFCs, uh, how the various categories of NBFCs has been defined by Reserve Bank of India, what kind of regulations are applicable on various categories of NBFCs, and various norms, provisioning norms, prudential norms, regulatory norms are applicable to each category in brief. So today is our first episode, which is focusing on only one category of the NBFC. And today's category is ICC, Investment and Credit Companies. NBFCs, investment and credit companies. And in fact, we would like to see investment and credit companies. Today, we would be discussing legal, regulatory, and compliance landscapes. Now, we will also discuss the overview and registration requirement, regulatory framework, prudential norms, compliance, and comment. So, when we talk about the NBFC, ICC, in short, we will, in our conversation with you, we will say ICC, that always means investment and credit companies. In fact, before this category ICC was announced by RBI, there used to be three separate categories. One was asset finance companies, the other was loan companies, and the other was investment companies. On 22nd of February 2019, RBI released a notification on harmonization of the non-banking financial companies category. Now, this category, under this, RBI, in fact, has decided to merge three different categories of NBFCs. Now, what was pre-2019? Now, the pre-2019 structure was asset finance companies were different, and they were, in fact, engaged in finances tangible economic assets like vehicles, machinery, and equipment. When we say economic, that also means that the asset would earn something, not only for human consumption, but asset will earn something. So based on the earning of these assets, there would be a finance, vehicle, machinery, equipment. The only consideration was that it is used in any business where some income would be derived out of these equipment. Then the loan companies, in short LCs, provides loans or advances as its core activity, excluding asset financing, because the asset financing that we have covered in asset finance companies, therefore providing loans or advances as its core activity, excluding financing. This was the second category of NBFCs. And the third category was investment companies, primarily engaged in acquiring and holding securities as its main business. Now, all the three got harmonized into one name, that is investment and credit companies. So it includes asset finance companies, loan companies, and investment companies. Now, the definition that we have seen after this merger, the definition is like, first of all, it should be a financial institutions as defined by the RBI, and principal business should involve asset financing, as we've already said, loans and advances, we've already explained, investment in securities, that we've already said. That is the definition. And also, very, very significant part of the definition is that NBFC ICC must not fall under any other specialized NBFC category as defined by the RBI. It's in its master directions, such as housing finance companies, microfinance companies, institutions, or even the infrastructure finance companies. If an NBFC, if an NBFC is engaged in asset financing, providing loans and advances, and investment in securities, it will be called investment and credit company. And in case, and that is up till either it should be categorized as any other category, like maybe housing finance, micro institutions, and others also. So in case it is not covered in any other category, so it is covered in NBFC ICC in case it fulfills all other conditions like 50/50 and various other basic regulations which are applicable to NBFCs. Now, why this harmonization was done, why this merger was done? It was done only for greater operational flexibility, as the companies can actually take more exposure into asset financing or loans and advances, or even investment in securities, and to undertake a broader range of financial activities under a single regulatory framework. That means reducing the operational silos. One, that unified regulations would also be issued. That was the purpose of the harmonization. The consolidation eliminates fragmented oversight, ensuring all NBFC ICCs adhere to the same regulatory standards, simplifying compliance and supervision. Now, the third important objective was alignment with the principal business test. That principal business test, RBI standardized the principal business test across NBFCs, all ICCs, to ensure that their core function is financial intermediation. Now, the principal business test is like 50% of the total assets must be financial assets, and 50% of the total gross income must be coming from the financial assets. For asset finance companies earlier, pre-2019, for asset finance companies, it used to be 60% economic assets or physical assets, and that was reduced to 50% because of this harmonization and merger. Now, the regulatory framework which is applicable to ICC, that is the Master Directions, non-banking financial institutions, and that is this is NBFC, non-banking financial scale-based regulation, which is SBR directions 2023, and which was updated on 17th July 2025. In fact, the scale-based regulations SBR was originally issued on 19th of October 2023, and thereafter there was again modifications on 10th of November 2023, on 21st of March 2024, on 10th of October 24, on 27th of February 25, 5th of May 25, and finally 17th of July 2025. So we are covering the master directions of RBI as updated up to 17th of July 2025, and this section 7 of this master directions that provides specific guidelines for ICCs and also for NBFC factors. Why there is a combination of ICC and NBFC factors, that we will come later, but this section 8 of the master directions provide specific guidelines for NBCC ICC and NBCC factors, and there is a correlation between the two. We'll explain it later. And then the scale-based regulations which was announced in and it was effective from October 2022, following the RBI's recognition that NBFC sector growth and complexity requires a more nuanced regulatory approach. So therefore, this the scale-based regulations, in fact, was introduced, and that was introduced with the objectives of proportional regulations. That means tailoring regulations to the size, complexity, and systemic importance of NBFCs to balance growth and stability. Now comes to the stability, that means financial stability. So the objective was mitigating systemic risk posed by large NBFCs, particularly those in the upper layer, through enhanced capital, governance, and risk management requirement. Then also, the major objective of the RBI is the investor and depositor protection. That means strengthening governance, transparency, and compliance to safeguard stakeholders. Harmonization was done, consolidating regulations to reduce compliance fragmentation and align with modern financial practices, such as digital lending and IT governance. Also, operational flexibility, which will allow NBFCs, including NBFCs ICC, to engage in diverse activities under a unified framework while ensuring regulatory oversight. Now, what is the what is operational flexibility? That is the investing in asset financing or securities or even giving loans. That is a flexibility. So the NBFC can shift from one segment to the other segment after the harmonization. Now, the structure of the scale-based regulations at the master directions, as we have already explained, the scale-based regulations master directions is organized into several chapters and sections. And section 7 specifically addresses the NBFC, ICC, and NBFC's factors. The framework, in fact, categorizes NBFCs into 4 layers, each with distinct regulatory requirement. This we have also said in the earlier episodes, but yes, this is most important. So we are, for the sake of even repeating, we are again saying, but in brief, base layers, NBFC base layer, that should be a non-deposit taking NBFC with asset less than 1,000 crore. With asset less than 1,000 crore, and that includes NBFCs with no public funds or customer interface. So the customer interface is a separate category of the NBFCs, like peer-to-peer financing or account aggregators. So that also no public fund, no P2P lending, and no account aggregator. That would be base layer. Also, regulatory requirements are minimal to encourage growth while ensuring basic compliances. Then comes the middle layer. Middle layer is deposit taking NBFCs, irrespective of asset size. Any NBFC which is accepting deposit will be considered in middle layer. Then whatever is the size, but second condition is that if the asset size goes beyond 1,000 crore, then it would be a middle layer NBFC. And specific NBFC categories like core investment companies, housing finance companies, and infrastructure finance companies can never be in the base layer. It will always be in the middle layer. Once a company starts accepting deposits, it has assets more than 1,000. It is a core investment company. It is a housing finance company. It is an infrastructure finance company. It is a peer-to-peer lending company. It is an account aggregator. It will be considered in middle layer. So the maximum NBFCs are being covered in middle layer. Then is the upper layer. Upper layer is the NBFCs identified specifically by RBI, which is based on the asset size, systemic risk, or a scoring methodology. Now, what is a scoring methodology? Scoring methodology is provided in Annexure 1 of the RBI Master Directions, and that deals with the methodology of scoring. Primarily, it is based on the size and leverage. It is also based on the interconnectedness, then complexity, nature and type of liabilities, and group structure and segment penetration. That is specifically selected by the RBI based on that score system, and then it will be categorized as upper layer. Coming to the top layer, reserve, it basically is reserved for NBFCs where the significant systemic risk is observed as determined by the RBI. Currently, this layer is empty. as the RBI has not assigned this category, this name to any NBFCs in the country. Now, scale-based regulations, master directions, in fact, consolidation. In fact, when this consolidation was done, in fact, it consolidated regulations issued by RBI's Department of Regulations, while guidelines from other departments like the Department of Supervision and non-banking supervision remains applicable. No, in fact, the Reserve Bank of India has various departments, but for the purpose of NBFCs, one is the Department of Regulations and the other is the Department of Supervision. Those are more active departments of Reserve Bank of India, which is relevant for NBFCs. Now, the NBFC ICC could lie in any of the layers of the regulatory structure, depending on the parameters of the scale-based regulatory framework, like asset size, group classification, and systemic importance. This is what is the basis of the scale-based regulations. Again, the layers that we have already explained, the base layer we've already explained, middle, upper, top, and asset side that we've already explained. The group exposure is also very important. The systemic importance, how the systemic importance is judged by RBI. As I said, that it uses the scoring-based model, and that actually based on the operations, interconnectedness with the financial system, complexity of the activities, leverage, and liquidity profile. So, Ankit, this is what is the basis, and then we will actually come to the specific regulatory requirements of NBFC's ICC. I would need your indulgence in case you would like to say something, Ankit.
No, I think this is pretty clear that like risk-based regulatory framework based on the if the organization is larger, it has higher risk, then it is required to do more. If it is deposit taking, it is required to do more. If it is, of course, using its own funds, then minimal intervention from the regulator. I think this is totally logical and understandable. If there are any questions from the participants, I can take those questions.
I think there is one hand raised. Maybe it is like by mistake by you only, probably.
So if there are any questions, maybe others can also raise their hands, but we can move forward, look at the regulations and then see how it moves forward.
Yes. So moving forward, and there is a net owned fund requirement for, in fact, all NBFCs. However, for NBFCs ICC, investment and credit companies, the direction number 6 is applicable regarding net owned fund requirement. RBI has specified 10 crores as the net owned fund requirement for an NBFC ICC to commence or carry on the business of non-banking financial institution, and there is a glide path which is provided by the RBI for NBFC ICC to achieve the net worth of 10 crores. In fact, a year before it was 2 crores, and then on 31st March 2025, it was raised up to 5 crores, and now all these NBFCs ICC would be required to have the net owned funds of 10 crores by March 2027. By March 2027, it would be required to have a net owned funds of 10 crore. Presently, after 31st of March 2025, the net owned fund requirement for obtaining a COR, Certificate of Registration, is 5 crores. In case this minimum net owned fund requirement is not met, then the COR will be cancelled. That is the minimum requirement to continue with the certificate of registration as NBFC. Now, to mitigate the risk and also kind of be more sensitive towards risk, Direction 95 of the master directions, it actually requires that chief risk officer would be appointed by NBFCs. Now, the chief applicability, let us understand what is the applicability of this regulation. NBFCs with asset size of more than 5,000 crore in ICC category shall appoint a chief risk officer with clearly specified role and responsibilities. Now, the rationale behind this direction was that with the increasing role of NBFCs in direct credit intermediation, there is a need of NBFCs to augment a risk management practice. So, therefore, a chief risk officer is required with a clear role. It is also mentioned very clearly in the directions that the CRO, the chief risk officer, would be completely independent and would be required to function independently so as to ensure highest standard of risk management. So the chief risk officer will take various decisions even independent of the board of directors. That is the post which has been created by RBI for those NBFCs ICC having asset size of more than 5,000 crores. Asset classification norms which are applicable to NBFC ICC. That is totally to classify their credit exposure, their asset side. Then first and foremost is standard assets where there is no default and they are performing as expected. Then there are substandard assets which are overdue for more than 90 days and the credit weakness is also evident and recovery is dependent on collateral security. So that means the regular inflow of installments, regular inflow of interest is not coming or it is overdue. However, the recovery is possible because of the collateral value of the collateral security. However, the credit weakness is also evident. So that asset will be categorized as substandard asset. Then is the doubtful asset. And these are specifically for NBFCs. And there is slight difference. There is a difference between the asset classification, which is applicable to banks and applicable to NBFCs. Although this classification, asset classification is also gliding towards the same norms as applicable to banks. But yes, there is some leverage presently given to NBFCs, which is through that glide path is coming very close to the banks. Doubtful debts, which remains substandard for more than 12 months. So first it will become substandard, and then if it remains substandard for more than 12 months, and there is a high uncertainty in recovery, that will be considered as doubtful assets. And then is the lost assets. Lost assets are identified as uncollectible by auditors or any internal review and must be written off in the books of account. Lost assets must be written off in the books of account. Then these special directions applicable to NBFCs regarding IT, information technology governance and risk management. Middle and upper layer NBFCs must comply with RBI master directions on IT governance, risk control and assurance practices. That is the directions dated 7th of November 2023, effective from 1st April 2024. Under these directions, the requirements are that all NBFCs in middle and upper layer would have a robust IT governance framework. IT governance framework with defined roles for board level committees and senior management. Continuous auditing, regular vulnerability assessments and enhanced vendor risk management. Compliance with the Digital Personal Data Protection Act to ensure data security. Compliance with the Digital Personal Data Protection Act to ensure data security. So, Ankit, I think there is a question, and you can even, as far as this IT part is concerned, you can explain better than me if you can explain it.
The question is relating to housing finance companies. That we'll come to that maybe after some time. With respect to NBFCs and the IT governance, now I believe the understanding is very clear that when you talk about banks and NBFCs and when you talk about risk assessment and risk controls, IT infrastructure is very, very important. And we see that whenever we go for bank audits, that in case the IT infrastructure enables the auto recognition of NPAs, since the interest is not recovered in case of working capital facilities for the last 90 days, or you have some other defaults, or you have term loan repayment not coming in for the next number of days. So all those risk assessments have to be, it's encouraged that they happen automatically as part of a system, as part of an IT system, and they're not manual. Because as soon as you have manual interference in NPA management or such risk management, it becomes riskier because then it will be dependent on some individual to take note of that or work on that or not. Therefore, I believe this IT systems are important because of that reason, that those IT-based risk controls should be in place in an organization. And apart from that, I believe that it's also important to kind of have a strong internal control per se to make sure that all the accounts are part of one IT system and everyone is working on that common IT system rather than having silos within the organization. Digital personal data protection is also important. That's also an IT-based issue that in case of NBFCs and banks, they have so much private data about the borrowers that it is important for this regulation to be in place that they are accountable to keep the data private. Because in case I want to apply for a loan, the bank will take all my ITRs, the bank will take all my KYCs, the bank will take maybe all the copies of my various property papers, and you never know in case somebody misuses those, in case they are hacked or taken away. So those personal data is also very important to be looked into. And with respect to vendors, yes, we see that some NBFCs and some banks have a system that they will assign valuation related work automatically. They will have a panel of 10 people, and the system will choose automatically as to which valuer is appointed. And that's like a system generated or system based approach to kind of make sure that uh, all values are getting the opportunity to do work, and that also reduces the risk that somebody is giving a specific job to a particular valuer because he wants a specific value and get that loan sanctioned. Also, we see that many a times many NBFCs have independent technical manager, technical valuation manager. That is also part of the risk framework. This independent technical value, this independent technical valuer is monitoring the various vendors who are empaneled as valuers, and this person then also kind of makes sure that the department is accountable for all the values that are being computed by the vendors empaneled by them. So it avoids that risk that the disbursement team is controlling the valuer's work. So this is also then an important part.
So good, Ankit. Thank you very much. This actually, like I knew that you are interacting with a lot of NBFCs for various kind of valuations, and therefore you definitely have contributed a lot in this particular part of the slide. Also, you have given me a gap to take my Dushanda. I was not taking a coffee or tea. I was taking Dushanda because today I have a bad throat and cold. And by speaking more, it actually gives kind of problem to the throat, so I was taking doshanda in between. I regret, audience, but Ankit, thank you very much that you give this kind of complete awareness to the audience regarding what exactly is the IT infrastructure means for NBFCs, to the extent that when they have to appoint a vendor, there also they have to adopt some kind of technology. I think that's very important that you explained. Coming back to our Section 7 of SBR, Scale-Based Regulations Master Directions, specific directions applicable to NBFC factors and NBFC's ICC registered under the Factoring Regulations Act 2011. And now there is a link between NBFC ICC and NBFC factor. So NBFC ICC can also start factoring services in case they register under the Factoring Regulation Act 2011 and they obtain a certificate of registration from the RBI as factoring service providers also. Now, ICC can become a factors. So let us understand what exactly is a factor. NBFC factors is considered as whose principal business is factoring. They must meet the principal business criteria that at least 50% of the total assets must be in factoring and at least 50% of the gross income must come from factoring. Also, they can engage in factoring if registered under the Act and meet RBI's eligibility criteria. So NBFC ICC can also register as NBFC factors, and the regulatory framework is the Factoring Regulation Act 2011 as amended in 2021 is applicable, and the Registration of Factors Regulation 2022 allows NBFC ICC to apply for a certificate of registration to act as factors. This amendment was aimed at expanding access to factoring for MSME and startups by allowing more NBFCs to participate. So when this factoring came, an option was given to various NBFCs ICC that if they can also obtain registration with RBI under the Factoring Regulation Act 2011 amended in 2021, so they would be able to do factoring and they would not be required to have a separate company for that. So the ICC can be converted into factors. Now, we also now would like to see what are the activities which are allowed for ICC. For NBFC ICC, in fact, are permitted to engage in a wide range of financial activities, provided they comply with the regulatory threshold and do not encroach on activities reserved for specialized NBFC categories. Now, these activities include providing loans and advances that can be secured or unsecured or for various purposes. Then is the asset financing. Financing tangible assets such as vehicles, machinery, and equipment, that we used to call it as asset financing companies, now merged with the ICC post 2019 wide harmonization directions. Then investment in securities, they can do acquiring and holding shares, bonds, debentures, and other financial instruments. Then factoring business. Engaging in factoring activities subject to registration as an NBFC factor. As an NBFC factor under the Factoring Regulation Amendment Act 2021. Then money market instruments, the investing in and trading instruments like commercial paper and certificate of deposits. These are money market instruments, and the NBFC are permitted to invest in these money market instruments. Now, see, like we have seen all this, what NBFC, ICC can do. So factoring is one part of it. We have seen asset financing, loan, investment in securities, and we've also seen this money market instrument. But for factoring, it is required to apply for factoring regulation 5 sub regulation 2 of the registration of factors, Reserve Bank regulations 2022, in fact states the eligibility criteria under direction 122 of the scale based regulation, which says that the existing NBFCs, ICCs can apply for certificate of registration if they meet these conditions. One, the NBFC is not accepting deposits to have 1,000 crore plus total assets as per their latest audited balance sheet, and also meet net owned fund requirement, are regulatory compliant. So this can apply for factoring, registration under factoring. Regulation 6 of the registration of factors, Reserve Bank of India Regulation 2022, in fact, also says the NBFC factors or eligible NBFC ICC which have been granted certificate of registration under the Act shall conduct factoring business in accordance with the Act and rules and regulations framed under the Act, or the directions and guidelines issued by the Reserve Bank of India from time to time. That's what is the requirement for factoring services. So in case we try to see a little more about factoring, because ICC and factoring is covered together. So then directions 122 says registration. Registration means any company wanting to do factoring must apply to RBI for a certificate of registration as NBFC factors and must meet principal business criteria as mentioned in directions 123. Principal business for NBFC factors. Now, the existing NBFC ICC can apply for COR if they meet these conditions. NBFC ICC that don't meet these conditions must convert to NBFC factors to do factoring services, must comply with the principal business criteria, PBC, principal business criteria, that is 50% assets and 50% income criteria. And then the third condition, they do not accept public deposits, have 1,000 plus meet owned fund requirement, and then they can submit an application with all required documents, surrender original COR issued as NBFC ICC under the RBI Act, and then finally direction 123, what is the principal business criteria that would be applicable to factoring IBC, and that is 50% asset out of the factory and 50% income from factoring. Continuous compliance with these threshold is mandatory. Failure to maintain them, risk cancellation of the certificate of registration. That actually will happen in case this 50-50 criteria is not met. Coming to the asset business conduct and asset classification. Direction 124 talks about the conduct of business. NBFC factors and NBFC ICC with certificate of registration under the Factoring Regulation Act must follow provisions of the Factoring Regulation Act and rules, regulations, and RBI guidelines issued from time to time. Regarding asset classification, directions 125 are applicable where NBFCs with assets less than 500 crores. NBFCs with assets less than 500 crores, there are different norms applicable for asset classification. In this case, if the receivables are overdue for more than 180 days, then that will be considered as NPA. It applies regardless of acquisition date or recourse type. Must follow glide path for NPA recognition. Glide path has said that this glide path is applicable to all NBFCs, and this 180 days will finally slightly come down to 90 days, and there is a glide path, and I will actually come to that later. what is the glide path, and however it will come to 90 days as it is applicable to banks. As I said in between, that all these asset classification norms are presently little liberal for NBFCs, but it will actually be matching with the banks in India. Then for assets, for all NBFCs having asset size of more than 500 crores, then if the receivables are overdue for more than 90 days, it will be NPA, and also it applies regardless. This time period of 90 days is applicable regardless of acquisition date and recourse type. Then provisioning based on exposure entity. Exposure entity is also important. That is for the purpose of declaring NPA. Exposure entity, in case the entity or their associate concerns, that of course will come later, that if any the group entity becomes NPA, so what exactly impact would be on this entity? So then must follow asset classification norms, which actually states must follow asset classification norms. As I said, the standard asset, substandard asset, doubtful asset, and loss assets. And Direction 126 also says reckoning of exposure. While we classify assets, we have seen one is the overdue period, 180 days and 90 days for different assets and for different NBFC based on asset size. Then is this 180 days or 90 days is not, it is regardless of the date of acquisition or the recourse type. Then the glide path is applicable to where it is 180 as of now, but where it is already 90, glide path is not applicable because they are already at the peak of the glide path. Then the provisioning is based on the exposure entity also. Exposure entity also, that is something which is very important, and I would like to say the reckoning of exposure with recourse factoring exposure on assigner and with the recourse factoring exposure on debtor. See, in the factoring, there are two kind of exposure. One is the exposure on the assigner and exposure on the debtor. Now, for example, if any person is supplying to Maruti and he comes to the factor and he says that I need discounting of this invoice, I need the advance against this invoice, and in case the Maruti will not give, I will give you the money back. Second is that in somebody who supplies to Maruti and he says that I'm assigning it to you, and but then in case the payment is not received on the due date, then I'm not responsible. You will have to collect back from Maruti. So these are the two kinds of exposures in factoring. So that also will depend, like the entity. Entity means the exposure entity. If the exposure is on Maruti, maybe it's a different asset classification. But if the exposure is on the NBF, if the exposure is on any other supplier, the assigner, then it can be different. So this is the based on the entity. Coming back to the directions 127 to 130 regarding risk management and operations. Direction 127 talks about risk management. It says that the NBFC factors and NBFC ICC must establish robust control and reporting system before starting factoring operations. Coming to Direction 128, credit appraisal must conduct thorough credit checks on debtor before factoring or setting credit lines with export factors. Direction 129 says genuine transactions and risk limit. The factoring must be based on genuine trade invoices. For without recourse factoring, board approved underwriting limit are mandatory. Board approved underwriting limit are mandatory. And Direction 120 says export import factoring must apply to RBI Foreign Exchange Department for authorization under FEMA. For import-export factoring, the factor, NBFC factor, must apply to Foreign Exchange Department for authorization under FEMA. and must comply with the applicable FEMA rules and directions. So the time frame, you see, like must commence, that's something which is different. So very important for factors. There are various uh, like directions 127, 128, 129, 130, and it actually talks about complete credit appraisal, risk management. Only genuine transactions are to be financed, and then export import. Then we have to take the permission from Foreign Exchange Department of RBI. So coming back to the permissible activity that we've already done, compliance exclusions. Now, the NBFCs, ICC are prohibited from undertaking activities reserved for other NBFC categories once specified thresholds are crossed. Now, the NBFC cannot do banking activities like accepting demand deposits or issuing checks. NBFCs cannot do housing finance. If the 60% of the assets are in housing finance, the entity must register as housing finance company. NBFCs are not supposed to do microfinance. In case 75% of the assets are in micro loans, the entity must register as microfinance institution. Infrastructure finance, like if the NBFCs more than 75% of the assets are infrastructure, the entity must register as an infrastructure finance company. So the specialized activities like factoring, of course, we have to get it done with the registration, peer-to-peer financing or account aggregator. If these activities exceeded their respective thresholds, the entity must register under the relevant NBFC categories. What I'm trying to say is that yes, peer-to-peer financing can also be done, but little bit. Account aggregation can also be done, but little bit. But in case housing finance can also be done, but in case this housing finance is exceeding a particular limit, then it will be required to be registered as housing finance company, similar for microfinance and similar for infrastructure finance. So there are some real world examples of NBFC's ICC. As I said, that the Bajaj Finance Limited is India's largest NBFC with assets exceeding 2 lakh crore, classified in the RBI's upper layer, requiring stringent capital to risk weighted ratio of 15% plus and robust risk management. Now, the activities offer personal loans, consumer durable financing, credit card loan, and other financial products primarily funded through market borrowings. Technology integration leverages advanced technology for credit underwriting, enabling efficient loan processing and risk assessment. Regulatory oversight closely monitored by RBI due to its scale and systemic importance. Similarly, Shriram Finance is also a company in the same category, a prominent NBFC ICC, focusing on transport and rural loans, serving underserved markets. Provides financing for commercial vehicles, agricultural equipments, and small business loans with a strong presence in rural and semi-urban areas. Technology and compliance uses technology for credit evaluation and adheres to RBI's regulatory framework for NBFC ICC. Similarly, Mahindra Finance also is a leading NBFC ICC specializing in financing for vehicles and rural market. It offers loans for tractors, commercial vehicles, and other rural focused financing, catering to agricultural and small business needs. Operates under NBFC ICC framework with technology driven credit assessment and risk management practices. We can see the challenges and regulatory considerations. There is a compliance burden on NBFCs. The unified regulatory framework, while simplifying oversight, imposes stringent requirements such as principal business test 50/50, or wherever the principal business revenue or assets are lying, accordingly category change. Net owned funds threshold and NPA classification, which can be challenging for smaller NBFCs. Conversion of NBFC to factors that we've already seen. Systemic risk, large NBFCs, ICC like Bajaj Finance, are subject to heightened security due to their systemic importance, requiring robust capital adequacy and risk management. Technology integration, as Ankit has explained, while technology enhances efficiency, it also introduces cyber security and data privacy risk, which NBFC ICC must address under RBI guidelines. So that is what we have for NBFC ICC. And we actually have also decided that with regard to the prudential norms and asset classification, we will have, after we cover all the categories, we will have a detailed analysis on how the like the asset classification, including classification as NPA, how does it applicable to NBFCs of different categories. So that we will have separate. So therefore, this way we would be covering every episode, one category, and whatever is applicable to that category with some of the examples of real life NBFCs. Ankit, we can take some of the questions if we have.
I will share a very interesting example that I myself witnessed. So I think many of us would be using Flipkart or Amazon, and there was this system, or there was this scenario where Amazon promoted by giving some kind of credit that I register myself for pay later at Amazon, and it gave me a small 15,000 rupee credit limit that I can choose not to pay from my bank or my credit card, but this 15,000 rupees will be pay later. Later, I realized that it was a partnership of Amazon with another financing entity, an NBFC, where the NBFC was at the back end, which was kind of bearing this cost of this money that I shopped for. And after about an year or so, when this contract expired, then I got a message from that very entity that you repaid your loan in full, and therefore you can apply for this personal loan in case you want to apply for that personal loan. So I'm sharing an example of how technology is evolving in this space. Now today, technology allows NBFCs to capture a lot of data that is available in the technical domain. Your shopping experience. In case you're using Cred will be using the data that they are collecting for high net worth individuals with respect to their payment styles and the style of repaying in time for various people with various agencies. There will be then Paytm, which is again collecting data with respect to what kind of transactions you're having on various banking channels that you're using for UPI. There will be other such databases that are getting generated. Of course, Sibyl is a very old system, it is still there. But then all these payment scenarios and payment histories are today what is relied on by all these technology agents to kind of sanction a loan within 5 minutes to you or decide not to sanction it within that time. I was discussing with a very senior banker day before yesterday only about how this technology based lending now is having another difficulty that many people are trying to trick the system. They are building some kind of a credit profile for smaller amounts and then trying to have a higher amount, which is then not paid by them or not serviced by them. Microfinance is also something which is always has a difficulty with respect to how people are able to pay those very micro loans that they are given. So yes, it's a very interesting space, this NBFC sector, and how various NBFCs have evolved themselves to manage risk and not to have too many losses with respect to NP and still grow their business.
I think
If
if
there
the
are,
question
yeah,
is
I
relevant, then we
think
can see.
if there is any question, maybe somebody can raise their hands. Mr. Rathi, if you can share.
Yeah.
Yes,
So my
please.
question is that NBFCs are regulated by RBI, but AIFs have been given a absolute free hand. So, as an expert, what do you think? When do you think RBI is going to go on AIFs which are into lending business?
I believe AIFs are being managed by SEBI. Again,
Yes,
a very,
they are
very robust.
regulated by SEBI. Yeah.
They are regulated by SEBI. Again, a very, very robust institution, and they also have the same objective of protecting investors. AIF collects money from mostly HNIs, and then they invest in either kind of whatever is the mandate to AIF. So they accordingly invest that. So AIF is fully controlled by SEBI. So I don't think there is any requirement of a dual control, one by RBI and one by SEBI. So even mutual funds are also controlled by SEBI. So the SEBI, in fact, also tries to protect investors. So RBI is not having any thought of controlling AIF functioning.
So it's basically a lending versus investment. I think we need to differentiate between lending and investment. When we talk about deposit taking NBFCs, we are looking at deposits, we're looking at NBFCs, we look at larger public money. When it comes to AIFs, the understanding is that AIFs are high risk investments. That is what AIFs declare to their investors also. AIFs also declare their investment philosophy with the investors, and if they are agreeing to invest, then they invest at their risk. So I think that's how I will differentiate that. Mutual funds versus AIFs, I don't see too much of a difference with respect to regulatory framework. NBFCs versus AIFs or NBFCs versus mutual funds, I think it's all dependent on what kind of they are all depending on systematic risks and also the size and also the investment versus lending thought process.
But I think one that Mr. Rathi is trying to take up a point that there are mushrooming in AIF segment. Everyone is trying to make one, two, or three AIFs, and they are also like pitching to the public at large for investment in their AIF. And the SEBI is presently not really very active on their, because SEBI has actually already said that it is a basically high risk investment, and I think there is a minimum size of investment, and that is, I believe, 1 crore. If Mr. Rathi has some information about AIFs more than us, then he can say that yes, minimum investment in any AIF is 1 crore. So that means
Yeah, it is correct. It is correct.
it is basically for high net worth individuals. So the market is kept open for them, that if they want to take risk, and it is assumed by SEBI and RBI and government that they should be given a kind of free hand to take risk, and they should ask information from AIF, and then only they will invest. So they are feeling, RBI and SEBI is feeling, that if a person is having 1 crore, that means that he's not a kind of masses. So he has that kind of access to professionals. So he can actually spend some money on the professionals to understand AIF and to understand the risk. That's what is probably the meaning. Any person who actually has 1 crore to invest in one AIF, that actually mean that he have the access to professionals also. Thank you, Mr. Rathi, for asking this question. I think we can.
I've got one more question. I will
Yes,
take
please.
just 30 seconds.
Yes, please.
So, I'm not sure whether in any of the series you have taken up the question of exorbitant pricing by NBFC. So, if you have not taken, I request that you kindly take it up. Whether NBFCs have some ceiling on how much they can charge in terms of processing fee, in terms of interest. Can it be 40%? Can it be 50%? I believe some of them have charged in the past that kind of rate. So whether RBI has got any objection to that, or RBI says it's free market.
No, see, like since we are insolvency experts, so we can also say one thing, that there is only one part in the insolvency law that is called extortionate transactions. Extortionate transactions means that anyone who is extorting money from the already stressed person or already financially stressed company, that extortional transactions can be minimized and it can be brought back to a normal transaction. However, to my surprise, that particular extortionate transaction, Section 50, is not applicable to NBFCs or any financial institution. Even if they are charging, say, 3% per month or 4% per month, it is accepted as far as, so it is not considered as extortionate transaction as per the forensic audit or as per the avoidance transactions under IBC. So what RBI thinks about it and what other judicial pronouncements that we will bring, as you are saying, that we will study and we will come back.
Thank you so much. Thank you so much.
Thank you. Thank you very much. Thanks.
Thank you, everyone. We will, it's above time, and we will then like to close and allow all our participants also to enjoy today's festivities. So, thank you, everyone, and always a pleasure to be spending the Saturday morning with you.
Thank you. It is our way of learning.